come now to part two. The question is that part two stand part. Stuart Nash.
Thank you very much, Mr. Chair. Part two of this bill basically is amendments to the Income Tax Act. This is, I suppose, I was going to say the substance of the bill. That's a little unfair. It's not, because everything is important. But this bill, just to give a little bit of background, is one of three bills that was designed to put the government's two-year bright line test into force. So what that is about, Mr. Chair, is there was a feeling that overseas speculators were coming into this country, investing in houses for making a very quick capital gain and on-selling the houses within 2 years. There was the IRD, and we've talked about this before, the IRD suggested a 5-year bright line. The Treasury or the Minister of Revenue rejected that. We're not too sure why, because it was certainly recommended by the IRD. But what needed to happen once that was in place is a whole lot of other legislation fell in right behind it to ensure that there was no way that that two-year bright line could be gamed. Because what we are talking about here, Mr. Chair, this is clauses, this is from part two, I should say clauses 34 through to, I'm not too sure where part two ends. It's quite a substantial part of the bill. It's quite technical. And I must admit, Mr. Chair, there was a lot of debate in our select committee trying to really tighten this up. And I must admit, we were lucky in the fact that we had our tax advisor. Our tax advisor is an incredible person who knows the tax law like the back of her hand. And she was very, very good in advising us on how we could actually make this better. And she worked very closely with the IRD in terms of tightening this up. But this is the residential land withholding tax. Like all withholding taxes, what it is it's a payment into an account when a transaction has been undertaken and a full amount has been settled upon, then the amount is paid to the government. But because we're talking about overseas owners here, or, well, the definition is quite wide actually, and Mr. Farfur might like to have a look at the definition of an overseas owner if he would like to. But what this is about is it's really, let me talk about the objective. The objective of the resident land withholding tax is to act as a collection mechanism for the bright line test. This is the sort of, I think the government would call this a capital gains tax when you're not having a capital gains tax. But what it is designed to do, Mr. Chair, is address an anomaly in our system which we feel very strongly about, and that is overseas speculation. Let's make no bones about this. This is overseas buyers coming into New Zealand, buying houses and not living in them. In fact, not even moving to this country and selling them without contributing anything at all. And I'm sure there are a number of speakers on our side who'll be keen to elaborate on this. But what it would require is, as mentioned, income tax to be paid on any gains from the disposal of residential land that is acquired and disposed of within 2 years, subject to some exceptions. And we did look at a number of exceptions. And with the introduction of the bright line test, we thought it was highly likely that overseas vendors who sell residential property within the 2 years will have a tax liability in relation to income from that property. However, we also acknowledge, and this is what this part of the bill does, we acknowledge that there is a general difficulty faced in collecting tax from foreign investors with no or limited presence in New Zealand. And we think that this tax would optimise the effectiveness of the bright line test and support the integrity of the tax system. And of course, the integrity of the tax system is something that has been talked about since we started debating this bill at 3 o'clock, and I suspect it will still be talked about by the time we wrap this bill up, and probably even in the next tax bill, which is on the order paper as well. The proposed tax is payable from the 1st of July 2016. And you know, this can have what we see in these 2 year sort of time frames is it can allow some interesting behaviour. So what we were really afraid of, Mr. Chair, is that someone would buy a house and sell it in 2 years and 1 day and reap the gains and pay no tax. And the concern we have here is that tax advisors in this country who are very, very adept at, what should I say, minimising tax, will provide advice now. If you're an overseas speculator, you're looking to buy a house, you want to avoid the residential land withholding tax, then make sure you can hold on to the, not you, Mr. Chair, make sure the investor can hold on to this property for just over 2 years. As mentioned, this tax is payable from the first, Mr. Chair.
Stuart Nash.
Thank you very much. That is payable from the 1st of July 2016 in the same circumstances as the Bright Line residential land income, except there is no main home exemption for this. And the reason there's no main home exemption is because we figured that this probably wasn't a main home that you're investigating or speculating in, because the focus of the residential land withholding tax is on New Zealand residential land sold by offshore persons. And again, offshore persons, as mentioned, the definition of an offshore person isn't necessarily who you may expect. New Zealanders are included in this definition, but that's something I'll elaborate on a little bit later. But a main home exemption is a compliance cost of marginal use. There will be an exemption for the disposal of inherited property, as well as a relief for relationship property. And we see this a lot in tax law. If someone has to dispose of a property under urgency due to a marriage failure or something, then there has to be provisions in tax law that allow this. It's proposed to impose a resident land withholding tax at a point in time when New Zealand land is sold by an offshore vendor, so as to improve the collection of any annual income tax for the Bright Line residential offshore income the offshore person might have. It was argued here, Mr. Chair, that the conveyancing lawyer would probably be the collection agent, but what was acknowledged in the Select Committee is that isn't necessarily the case. But what we also did, and Mr. Scott may talk on this because he had some very interesting points to make in the Select Committee, is that we need to ensure that the conveyancing agent, the conveyancing agent, which is, as mentioned, normally a lawyer, and we can talk about a lawyer in this case, I suppose, but you know, it's not always, is not held liable for information he or she might not have had at a time and point when the residential land withholding tax or when the seller disposed of the property. The payment of the residential land withholding tax generates a tax credit that may be used to pay annual income tax liability for the Bright Line test residential land income. If the tax credit for the land resident withholding tax does not need to pay income tax liability, then that tax credit is actually refunded. And again, this goes to the principle of tax law. You take tax when there's tax payable, you refund tax when there's a loss. There's nothing unusual in that. Now let's talk about an offshore person, because an offshore person also includes a New Zealand citizen who is living overseas. Now, that's if they have been overseas for the last 3 years. So again, what we're looking at here, Mr. Chair, is speculating in a market where I suppose you could say that person isn't contributing in any way, shape or form. You know, at least in New Zealand, if you own speculative property, you are, not you, an investor is paying tax. That tax is contributing to the upkeep of roads and schools and other core services. But if an investor is living overseas and they're investing in property, then I think it is very difficult to make an argument that they are contributing even in, another way through their taxes and their GST, etc., etc. So this does include a New Zealander living offshore if they have been overseas for 3 years. An individual who holds a New Zealand residence class visa may be an offshore person if they have been living overseas for the last 12 months. New Zealand trusts and companies may therefore be offshore persons if there is a significant offshore interest in them. And again, we debated around what constituted an offshore trust or an offshore company. At the point in time, Mr. Chair, I can't recall if we looked at blind trusts. I suspect we didn't. I suspect now, if we were looking at this bill, we would pay particular attention to trusts for who that were blind or were overseas trusts or that were holding assets in New Zealand. We might have looked at this in a slightly different way, given the whole integrity of the New Zealand tax system has been called into account with recent events. But that's a conversation for another day or another time or another reading. The mechanism proposed for the collection of the resident land withholding tax, as mentioned, is at a point in time when the land located in New Zealand is disposed of, excuse me, primarily an obligation of the offshore personal vendor. It's proposed the offshore vendor's conveyancer, as mentioned, usually a lawyer, or in absence of the vendor's conveyancer, the purchaser's conveyancer is treated as the resident land withholding tax agent of the offshore vendor. In absence of the vendor's conveyancer,
The Reverend Dr. David Clark.